Welcome back. This is the Mortgage Sensei here. Today we're going to be discussing debt to income ratio. What is it? How you can use it in order to get qualified for the home that the bank will lend money to you on. Now, first thing to understand when it comes to debt to income ratio is the importance of debt to income ratio. This particular equation by far is the number one reason why most people can't get into a home. A lot of people think it is credit, right? Credit is secondary. Debt to income ratio is always the number one reason. When it comes to how much house you can qualify for, you know, what what your closing, what your payment is going to ultimately be based off of what your income is coming in. So again, debt to income ratio is number one. Number two is credit. Credit that may determine how much of a debt to income ratio or how high the limit you can go, but before you even get to talking about limits, you first have to have income and debts. Okay. Now, let's talk about this a little bit better. So let's put down debts to income. Okay. All right. So we're talking about debt to income. Okay. Now, when we're talking about debt, the first thing we have to determine is what debt are the banks looking for, right? What are Nelson? What are they? Okay, what calculation? What payment? What balance? What are we looking for when it comes to debt? Let's get right to it. So when we're talking about debt, if I can break it down into sections here to really help everyone. The first thing we want to talk about when it comes to debt is installment. I do. I tell people all the time. I do math. I'm not great when it comes to spelling. So if I spelled it wrong, apologize. But look it up and you'll get it right. So let's talk about installment, right? Installment. What is an installment? Okay. For those that don't know, it's auto loans. It is student loans. It's a mortgage. It is a personal loan. Okay. That's what an installment loan is. Okay. Now, this is the bank, right? This is the bank. Okay. So an installment loan is in a situation where okay, you go to the bank gives you money, say it gives you $10,000, right? And they say, okay, you're gonna get $10,000, you're gonna pay us back $200 a month. Okay. You then leave the bank, right, to go purchase whatever asset that you're looking to purchase or liability, whatever. But whatever personal property you're looking to purchase or whatever real property you're looking to purchase. And then over the course of time, you over here, you make payments back to the bank based off $200 a month. You make payments back to the bank and you can't go back and get more money, right? So you go in, the bank lends you the money, tells you what the terms are, the finance charge, so on and so forth, monthly payment. You then go and buy the personal property or the real property or whatever it is that you're looking to do, right? And then you pay the bank back over time. That's an installment loan. Okay. Again, think auto loans, student loans, mortgages, personal loans. Those are pretty standard. Okay. Now, when we're looking at the debt to income ratio when it comes to this, okay, what we're focused on is the monthly payment. What is the monthly payment in which you're paying when it comes to that installment loan debt? And we start to add them up. Okay. Let's say the auto loan over here. Let's use an example. So the auto loan that you got is $500, right? The student loan, right? Oh, Nelson, I'm making zero payments on your student loan. We're going to address that in just a second. You don't have a mortgage because you're trying to go buy a house, you're renting, right? And then let's say you do have a personal loan and you're paying that back at $100, okay? So most people will say, oh, okay, well, I have $600 in installment loan debts. It's not 100% true, okay? When the lender is looking at this and they said, okay, the student loan is zero or you're deferred, in your monthly payment when it comes to your student loans, then we as lenders, we have to use a multiplier or make up a payment. This is what people normally would say. But we have to use a multiplier when it comes to your student loans. Now, depending on the program, like FHA, it is 0.5%. With Fannie Mae is 1%, right? Just to throw two things out real fast. But we'll have to make up a monthly payment according to the amount of the student loan debt. So let's say that the student loan debt that you owe is $50,000. Okay. You can be more, you can be less, right? But we're just going to use $50,000. Okay. So at $50,000 that you deferred, right? The government, the program, whatever, has said, hey, if you don't make if you stay in this industry or do whatever the terms and conditions are, whatever the conditions are of the loan, we'll forgive the debt, 10 years out in the future, right? Fantastic, that's great, and you should go about, whatever you should do in order to get it discharged or get it, removed according to whatever the terms or conditions of the agreement. But when it comes to getting a home, it doesn't work like that. Right? You have options. Now, in most cases, and FHA is normally what I like to talk about because most people can get into a home at FHA. Conventional loans are phenomenal. I prefer conventional loans, but let's be realistic. A lot of people can't qualify for conventional loans, and so FHA tends to be, the route that we have to go. So when we're talking about the payments for the student loan, again, FHA uses 0.5%, right? That's for FHA. And then conventional loans like Fannie Mae uses 1%, just to give you an example. Okay, and we'll go more into programs in a loaded video, but we just want to talk about debt to income ratio. Okay, so if we got $50,000, right? And we're saying that, okay, FHA is, or let's go Fannie Mae, keep it simple. Fannie Mae is 1% of the balance that we have. Then, of course, we take away 1, 2 zeros. And now we're talking about a monthly payment of 500, right? 500. Let's make sure our math is right. 500, okay? So that's 1%. A half a percent is 250, right? I know you deferred. I know you're not making a payment. I know you don't have that set up, right? But that's the monthly payment that we're going to calculate as a lender when it comes to your debt to income ratio, when it comes to installment loans, okay? So we got, let's say we're going to FHA. So we have an auto loan that's 500. We got the student loan that's 250, right? So that's 750. We got 100 here. We're actually at 850 in debts. Okay. Now that is installment loans, everyone. The next thing we want to talk about when it comes to debt to income ratio, let me just kind of clear this off. You can always pause and play it back. Beautiful thing about the internet. All right. So the next thing we want to talk about when it comes to debt to income ratio, again, we're still staying with debts. Next thing we want to talk about is revolving. Revolving accounts. Okay. Revolving accounts. Okay. Again, what are revolving accounts? Credit cards, furniture cards. So, furniture cards. So when you imagine you go to Ashley Home Furniture or whatever, right? No, not shouting out any particular furniture company here, but let's say you go to the furniture company, right? And you walk in, you say, "Hey, I want to buy this section, right? Or I want to buy this is my wife's area. To be honest, people, I don't know the terminology, so sorry for everyone that's very much of an expert in that area. But let's say I want to go buy this set, okay? and the set costs you, I don't know, $5,000. It may be cheap, it may be more, I don't know. But let's say it costs $5,000 for this set, okay? And you're like, well, you get to the front desk or the salesperson or something like that. Like, again, I don't really go to these stores, but you get up there and they say, hey, you know, you don't have to pay $5,000 cash for it, right? We'll give you 0% no interest for 12 months, 24 months, whatever the case may be. No payments for 12 months, whatever the condition is. And you can get it, you can drive home today, keep $5,000 in your pocket, right? Well, you got to be careful with those type of things, right? What happens is they'll say, okay, your balance or the cost for the furniture is $5,000 even, including tax, just hypothetically. You fill out the application, right? They'll run your credit. Boom, you qualify. You walk out. What all they did was they opened up a revolving credit card, right? You just call it a furniture card. They opened up a credit card with a $5,000 limit. And then they added $5,000 balance to it. So you got a $5,000 credit limit, $5,000 balance. You got a maxed out credit card, but hey, you ain't pay $5,000 today. So furniture cards. You got store cards, right? Store cards. Macy's, JCPenney's, Best Buy, Amazon. You got store cards, right? You have medical cards. Care Credit is one that I see a lot. Care Credit. So you have medical cards, credit cards, furniture cards, store cards, medical cards, right? Anything where, again, let's get the bank back up here, right? This is the bank. Okay, and this is you over here. All right, you got the bank and you over here, right? You go to the bank. You say, hey, bank, right? I wanna get a line of credit. Okay. So the bank says, okay, we're going to give you a line of credit for $5,000. Right? We're going to give you a $5,000 line of credit. Well, we're going to keep the $5,000 over here, right? But we're going to give you a $5,000 line of credit. Okay. And you say, okay, great. Then you go to whatever the department store is, right? Let's put a car here just to give you an example. You don't do this with auto loans, but you go over there, you drive over to whatever the bank, or you still at the store, right? But then you go there, and let's say the personal property, that you're purchasing is $1,000. Okay. You got $1,000. That comes off of the 5,000. Now you got 4,000 in credit available here with the bank still. Okay. And then you can go back again. Let's say before you got home, you drive home, you're like, oh man, I want to go to that store. I've never been to that store. You walk in that store, you drop another $2,000 on that same credit card, right? You got $2,000 left. No. Okay. Then you pay it. Then you say, okay, the end of the month is coming, right? I'm getting close to my statement date, not my due date, my statement date. And then I pay the bank, right? You're over here. You pay the balance, $2,000, right? So that $2,000 that you had now becomes $4,000, and you can borrow more money off of it. It's a revolving door. Okay, you go there, you borrow, you pay it down, borrow, 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 pay it down. That's literally what you're doing when it comes to revolving accounts. Now, when it comes to debt to income ratio, dealing with revolving accounts, what we care about only is, I'm gonna put it right here, is the minimum monthly payment. That's all we care about when it comes to calculating your debt to income ratio. What is your minimum monthly payment? So we'll look at the credit cards. Either it can be $25, it can be $10, it can be $500, right? Whatever the minimum monthly payment is when it comes to that credit card, we take that number and we add it to the debts that we had. Now in our earlier one, we had the $500 auto loan. we had the $250 for the student loan, and then we had I think it was $100 for the personal loan, which summed up to $850, right? So then let's put this off to the side. So 850 was for the installment loans. Okay. So then let's say we got a credit card. This credit card is paying, we're paying that is $100 a month. Let's say we got this furniture card over here, right? Let's say that's zero payment. Great, that's fantastic. You got a Target card, Best Buy card, whatever the case may be. You're paying $150 over here, right? And then you got a medical card, right? You had to do some things, medical things, hopefully you're okay and still kicking around. And then you're paying, let's pay, I don't know, $100 here, right? Let's keep it simple. Okay, so we got $100, that's $200, and then 150 here, that's 350, right? So we got $350. Well, Nelson, I got 0% interest, but I got a balance on this furniture card. Doesn't work the same way with installment loans, right? If it says zero, it's zero. That's the way it works. Okay, so now we're adding this up. So that's revolving accounts. Again, please drop a comment if you want more in-depth understanding when it comes to revolving accounts. Let's get this taken off here. All right. Now, next thing we want to talk about, again, we're still with debts here. Still with debts, okay? Next thing we want to talk about is open accounts. Open accounts. Okay, so open accounts is contracts for service, contracts for products, right? Now, open accounts can be, normally they're like a lease of some kind, right? Auto lease. They're subscriptions. Those are normally what open accounts are, right? Subscriptions and leases can include like utility bills, cell phone bills, so on and so forth, right? Now, it starts to get a little tricky here, okay? Now, when it comes to open accounts, right? Normally, we're more concerned with leases than we are with subscriptions, okay? Especially when you're going with programs like FHA. Now, different programs, they started taking into account. I know VA tends to get a little particular there, but let's just keep it simple. So a lease, auto loan lease, let's say you're leasing your primary residence, right? You're renting your primary residence, but you're trying to buy a second unit, right? I know there's people out there that does that. Those will be included, right? Which like your Netflix bill, utility bill, anything that's considered more a living expense than a debt type of expense, most of the time you can probably exclude those from your calculation, right? So that's all I'm going to talk there, kind of move away from that. All right, so the next thing we want to talk about, again, we're still with debts here. Next thing we want to talk about is collections. Collections. Okay. Now, again, depending on the program, this is not a specific, like all programs work the same way, right? Especially when you're going from conventional loan to FHA to the VA, right? Or any kind of non-QM products, which we'll get into detail on each program at a later time. But we're just trying to keep it general and broad, give you an understanding of, again, the main point, debt to income, okay? Now, when it comes to collections, I'm putting up collections more specifically because when you're dealing with collections, right, with most programs, when you have more than, so I'm gonna put let's put the collection is more than $2,000 balance, and this is non-medical. Okay. Now, what I'm saying here is that let's say you have a collections, right? It can be a collection with your cell phone bill. It can be a collection from the state. It can be a collection on a furniture. It can be a collection. I mean, it can be a collection for anything, right? But the difference is it medical related or is it non-medical related, right? Now, later this year, I believe, the government is looking to exclude all medical collections off of your credit report. right? This is going to help a lot of people qualify. It's going to help greatly with credit as well. But as of right now, the timing of this video, right? If it is a non-medical collection, and it has to say in your credit report medical, okay? But if it is a non-medical collection, and all of your collections total exceed $2,000, so $2,001 or more, right? Then we have to make up a payment just like we did with the student loan, right? In most cases, it is 5% of the balance, 5% of the balance, whatever the balance is, okay? So let me give you an example. So you have a, let's say you have I see apartment collections, right? So you say you got an apartment collection, that's $4,000, right? Let's say you got a, oh, Verizon, I see that sometimes. Verizon collection, that's $500, right? Where at, Nelson? I know. So Verizon collection is $500. And let's say you have a, I don't know, well, mine racing right now. Let's just say you just have another non-medical collection, and that's $1,500, right? Okay. So then and these are the balances. Again, this is just the balance because most collections aren't going to report a monthly payment to your credit report, right? They're just going to normally just report a balance or a past due amount, but a balance. So we add these balances up. 400 plus the 5, that's 45, or 4,000 plus the 5, that's 4,500. Plus another 5 plus the 1, 6. So we're talking about $6,000. $6,000 in total non-medical collection debt. Okay. Y'all, Nelson, I don't show a monthly payment for those. I understand, but this is how it works. So you take that and you multiply that by 5%. Okay. Boom, boom. Take that by 3. That's $300. So now you got another $300 added to your debt section. And that's for non-medical collection. If it's a medical collection, we just kind of ignore it. Be honest, we ignore it like it doesn't even exist. Okay. Now it would not, but medical collections will affect your credit score, but it doesn't affect your debt to income ratio. Okay, there's a difference there. Okay. All right. So we talked about collections. Charge-offs. I'm not going to put it up there because charge-off, we just ignore it altogether because it's charged off. There's no debt being pursued. It's just a derogatory remark. And now those are your basics when it comes to debt to income ratio. Now, the next thing we want to talk about, again, we're staying in debt, right? Now, this is one that most people just aren't aware of. You have what is called a Cavers report, right? Cavers report, okay? Now, a Cavers report is any lien, judgment, encumbrances, anything along those lines that are reported through the court system, not the credit bureaus, Equifax, TransUnion, and Experian, but through the court system, county, the state, federal, right, local, so on and so forth. This is filed through the court system. So think alimony, child support, separate maintenance. Let's think about bankruptcy repayments with a chapter 13. So let's put up here. So put child support. And this is you paying money out, not receiving money. You paying money out. All right, so child support, alimony, separate maintenance. Let's put a chapter 13 BK, right? IRS, repayment. State, repayment, income taxes, so on and so forth, right? Those are just some quick examples of debts that you're paying out, okay? Now, these are not considered living expenses, okay? These are considered debts that need to be paid. So it's added to your debt to income ratio, whatever it is. So you have your installment loans, your revolving account, your collections, and then everything that shows up in your CAVERS report, right? Or it may be on your credit report as well, but if it's filed through the court system, you got and you have to pay it, and you should be paying it if they tell you have to pay it, unless you know something I don't know. Then all of that is added to your debt section. Okay, so let's say this guy has $300 child support, nothing in alimony, nothing separate maintenance. I normally don't see anything there. Bankruptcy is 0. IRS, we'll say 0. The state is 0 as well, right? But if they had something, we'll add it to it. So we add another $300. Okay. Now that basically takes care of all of the debt section, right? Now there are one-off situations, but we're talking about less than 10% of people out there, so don't freak out. Okay. So let's add this up. So we got we got 600 here, right? We just add another. That's 950, right? And then that's 1,000. So we got $1,800, right, in debt so far. That's what we're sitting at. $1,800 in debt. Let's move this up here. Okay. Now, the last thing that needs to be added to the debt to income ratio is the housing expense. Housing expense, right? Now, what housing expense is, what is the monthly payment for the new house in which you're getting? Right? We got to add that to the debt to income ratio. So the debts that you already have, that you've been paying or should be paying, plus the new debt that you're going to be paying, plus any new debt that you maybe got during the process, right? You want to open up a credit card, you want to get a new loan, you about to close, you want to open up a new, you would have bought a new car, yeah, all that gets added to your debt to your income ratio before you close and fund your loan. So be careful out there, okay? But your housing expense includes the principal, interest, the homeowner insurance, property tax, and the homeowners association dues. Or we just put here HOA. Okay, just put HOA. Right. So the housing expense for the new payment, right, for the new house, okay, that you're buying, whatever the house is, primary investment, second home, whatever it is, you're buying it. There's a housing expense, broken down onto a monthly basis. Everything is based off of a monthly basis, right? So you have your principal, interest, taxes, insurance, and the homeowner's insurance or community dues for the property in which you purchase, right? All of that broken down into a monthly recurring payment. We'll take that payment and we add it to the debts that we already calculated before. So let's say, let's keep it somewhat simple. Let's say you're looking at a $400,000 house. Let's say it's somewhere around $2,800. Right, that's a good safe number. So $2,800 for a $400,000 house. We add that to the debts up here, right? So we got, what's that, 1646, something like that, right? $4,600 in total debts. That's what we're looking at, okay? My math should be right. Okay, so that's it for debts. We're gonna put our total 4,600 for total debts. Again, debts that shows up on credit using proper calculation, debts that shows up on CAVERS using proper calculation, and the debt for the new housing payment in which you're getting, right? Also, if you own any houses, right, principal, interest, taxes, insurance, homeowners association, the whole 9 yards, or unless you're using tax returns, right? But basically, the housing debt for the properties that you own as well. So you have that. divided by your calculated income. Calculated income. Now, I'm gonna have a whole section on just calculating income, right? But your calculated income, if you are W-2, right? We're using your gross income. If you are W-2, we use your gross income. Gross income is before taxes, before Social Security, before state, before anything that comes out of your check, right? We're using gross income. If you are 1099, we're using net income in most cases, unless you're using a specialty product. But in most cases, we're using net income, and that is normally driven from your Schedule C. From your Schedule C off of your tax returns. Okay? If you are self-employed, right? If you're self-employed, in most cases, we are looking at a Schedule C, right? If you're a business owner, we're looking at your K1s, your 1120, right? Maybe your 1120S, okay? Partnership forms, right? We're looking at those and we're calculating net income. Okay, so if you're W-2, gross income. If you're 1099, net income, but we're deriving that normally from your Schedule C that's filed with your 1040s. If you're self-employed, Schedule C. If you that's normally like LLCs, sole proprietors, right? We're pulling that from Schedule C. If you're S corp, we're pulling that normally from the K1s. If you're C corp, we're getting in depth into your 1120. Okay, and we're using net income. If you are self-employed and you are Schedule C, or if you're S corp or C corp and you salary yourself, that salary portion that we use is considered gross income, and we can use that gross amount. But that's normally what we're using there. Let's say you have rental properties, right? Rental properties. Rental properties, we can do it a couple of different ways, okay? One of the ways we can use rental property to qualify is utilizing the Schedule E. Schedule E form that you file with your 1040s. We can use the lease agreement. Close enough. Lease agreement, or we can use rent schedule. Rent schedule, appraisal. So now those are normally the three ways we can use to calculate rental properties. So let's talk about these real fast. So Schedule E, this is basically you taking all of your gross receipts from the rents that you collected, and then you fill out a Schedule E form. Sorry, E is in echo. Schedule E form, and you bring in all of the receipts or the invoices for the property taxes, the homeowner's insurance, any maintenance, any property management, mortgage interest, right? You bring all that together, put it on the Schedule E, do your calculations or whatever, and you derive the income. We use an equation in the most simplistic way to explain it. We'll use line number 31, which is your net income. We'll add back in we'll add back in mortgage interest. We'll add back in homeowners insurance and property taxes. We'll add that back in when it comes to calculating your income. All right, because we don't want to double dip we don't want to double dip when it comes to your insurance, also your homeowners association dues. We want to add that back into your qualifying income. We don't want to double dip on that. Property taxes, we don't want to double dip on that, right? We can add those back in, just kind of be, simple. And then we'll use 100% of the calculation. Now for a lease agreement, right? So, instead of using a Schedule E, you provide the lease agreement, right? Maybe some canceled checks, some banks will do that. So instead of using a Schedule E for whatever reason. So they'll take the lease agreement and whatever the gross rent is, they'll multiply it by 75%. So they'll take 25% reduction off of it, assuming expenses, right? But 75%, and then there you go, right? When it comes to the rent schedule for the appraisal, similar fashion depending on the bank. Right now, I've seen 100%, I've seen 75%. But they're gonna go out there and instead of you providing Schedule E and providing a lease agreement, or it might be in addition to, depending again on the bank that you work with, they will go about and obtain an appraisal on your rental property. You may not be getting a loan on the rental property, but you get an appraisal on the rental property, a rent schedule appraisal. It tells what the going rent is in the area for your property that you currently already own. And based off of that rent that they give you through that appraisal report, that's what they will use to help you qualify. Okay. Now, so when it's all said and done, okay, we'll calculate your income accordingly. All right. You may be in one or multiple sections, right? Each person is different when it comes to their debt to income ratio. Okay. Now, again, as I stated when we first started this, the debt to income ratio is the number one reason why you will or will not qualify for a loan. Your credit score is your number two reason why you will or won't qualify for a loan. Your debt to income ratio never, ever, ever, ever dictate what your interest rate is. Your credit score does that. Your credit score dictates what your interest rate is and normally what program you can go with, right? Or want to go with, right? Now, based off of your credit score will then give you an allowance on how much of your debt to income ratio that a particular program may use, okay? Like for instance, let's talk FHA, just real fast. So FHA, okay? At a FHA, technically, keyword is technically, you go up to 57% debt to income ratio. Meaning that if you are, let's say you have $10,000 in calculated gross income, right? The total debt is $5,700, right? And that will include, again, installments, credit cards, collections, right? All calculated property, anything that shows up on Cadence, alimony, child support, separate maintenance, so on and so forth, right? And the new housing payment, and the housing payment for any other properties that you currently own, right? For FHA, which is primary residence only, okay? But you can go up to 57%, all right? Now, that's contingent on your credit score, okay? If you have a lower credit score, like I said, anything probably going under 640. That's why I always tell people 640 is the magic number. But if you have a credit score normally in 640, then the lender reserves the right to lower the risk of the file and say, okay, instead of going with 57, maybe they'll cap you at 50. Maybe they cap you at 43. And so on and so forth, right? Debt to income ratio, okay? Now, the last thing I want to talk about here is the two versions of debt to income ratio. Oh, Nelson, you went through all of that. And now you telling me there's two different versions? Yes, there's two different versions. Now, if this is a more simplistic way, now that we went through it, it'll make a lot of sense since I put it on the tail end. We have what is called your total DTI or debt to income ratio, and then your housing DTI. Okay. Now, let me explain the difference between the total debt to income ratio and the housing debt to income ratio. One of the things that we look at, so let's go back to FHA, right? Because it's fresh on your mind, and we just quickly discussed it. But with FHA, I stated that they'll go up to 57% debt to income ratio. That is total debt to income ratio. Your total debts plus your housing debt. Total debt, housing debt, max 57%, contingent on your credit score. Contingent on your credit score. The higher the better, right? Now, when we talk about your housing debt, the housing debt only takes the housing the account the debt for the home that you're purchasing, right? Principal, interest, taxes, and insurance of the house in which you're buying. Okay. So in a scenario like this, we have a front end ratio and we have a back end ratio. The front end ratio is always your housing debt or the monthly payment for the home in which you're getting the loan on, right? That is always here on the front. I put 35% because that's a good healthy number. You can always get higher than that, but again, the higher the credit, the more you can flex on your debt to income ratio. So your housing debt to income ratio, right, is for the home in which you're purchasing, principal, interest, taxes, insurance, community, homeowners association dues, broken down into a monthly payment, divided by your calculated income. I didn't say gross income, I said calculated income. You might be self-employed. You might get you might get Social Security, right? You might get any other pension or something like that, right? All of it's a little different, okay? But for the most part, this is how we calculate your debt to income ratio, okay? Now, again, this is only meant to help you understand better what's going on. But your loan originator, right, or the person that is assisting you through the process of home ownership should already know what everything I just went over here and more, a lot more, right? This is just a crash course when it comes to debt to income ratio. Outside of that, that covers everything when it comes to debt to income ratio. Now, I know there are going to be some professionals. I know there's going to be some experts in the comments. Like, oh, Nelson, you forgot about this. Oh, Nelson, you forgot about that. Oh, Nelson, you forgot about that. And you're right. I know for a fact that I left out some things. But the point of this is to help people that know nothing or very little about the home buying process, to get them caught up in such a fast way where they can then understand what these terms and understand what they need to do in order to get prepared before they walk through our doors in order to obtain a mortgage, obtain a loan, right? Because one of the biggest things, and I'll leave it here, one of the biggest things that makes me upset personally is that when a client is dealing with another lender, another bank, and they get their hopes up, right? Hopes up, right? And they're trying to buy this house. They go on the contract, put the security deposit down. Realtors, you know what I'm talking about. Put the security deposit down, and they're going to go through and they're going to buy this house. And they go 2-3 weeks, and they get denied. And they get denied because of debt to income ratio, right? Or they get denied because of credit, which then leads to debt to income ratio, right? When that happens, it is devastating to the client. And then you'll have people, there's a good percentage of people, there probably about 30% of people out there that just honestly believe that they will never own a home. And this channel is for those people and more, but this channel is to help encourage those that know nothing about the home buying process, because it's complicated and it's complex, right? It's hard, it's a lot to take in and digest, right? But this is designed in order to help those people to feel more confident, to feel more educated about the home buying process. That way they can get their ducks in a row in order to get prepared to go in and buy a home. That'll end it for today. The next video that we'll be discussing is going to have to do with assets, funds to closing, right? We're going to go into that a little bit more in detail to talk about what you can and can't do when it comes to assets. But hopefully this is jam-packed. If you would, please like, share, subscribe. Also comment I'll do my best again. I'll do my best to get back to everyone. But comment if you need a better explanation, if you have some questions. Let's say you want to run a scenario, right? Hey Nelson, this is my scenario. Can you run a scenario for me? I will be happy to take some time and help people through their personal situation. If you want to make your financial situation public, that's fine, right? I have no problem going through it and keeping it general, right? I'm not saying you qualify, I'm not saying you disqualify, but keeping it general, right? You're gonna see the links at the bottom to gain access to updating your credit report, to gain access to completing a loan application, to gain access to getting a list of items that's uploaded, and then very soon we have the copywritten done on the book, How to Buy a Home with a Loan. It is copywritten. It is going up for publishing through Amazon. I'll put a link in the description when it is, or once it is available. It should be done fairly soon, and I'll update it. And I wish you all the best, and see you on the other side of home ownership. Mortgage Sensei out.